Just give us a couple of seconds and we'll jump back on, and we'll be right with you. Thanks. Okay. Dan's working on this in the background, so we'll see how things roll through the next couple of minutes. But what I wanted to do is, first of all, welcome you to the quarterly conversations. I believe this is the third time we've done it. It's still a little sketchy in the way we try to run it, but the whole goal is really to run this quarterly conversations like just a regular conversation that we're having with you. So you have a chat screen down the bottom, and a question and answer down the bottom. You can actually jump on that question and answer as we go along, and you can ask questions through that, and we can respond to them as needed. But again, welcome to Quarterly Conversations. Today, what we're going to do is we are going to go over a couple of different things, actually. My computer's moving a little bit slow. But first of all, we're going to talk a little bit about Tina. You saw that in the quarterly letter, where Tina leaves us where there is no alternative to low interest rates and what adjustments that are available out there that we got to make. We also, in this current market condition, you blink and it might be just a little too late to step in. So the market moves fast, especially this year. The central bank still plays a major role in the outcome of the market. There is economic optimism out there, and we're going to talk a little bit about that today. And then we also have a potential changing of the guard. The question is what, when, and where this new generation is going to step up and shift and take over for the next market to come. And then we'll talk a little bit further about the secular bull market and the potential that we have out there where this market can continue to run. So I believe Dan is on board.
I'm on board. I'm here. You just can't see me.
I can't see you. That makes it more difficult.
Exactly.
We got to start the fireside chats in the same place next time.
Yeah, the big brother is not letting me show my face, but I think we may be able to fix this where we can just pass this off, Rick, between me and you. So
go for it. They don't need to see me.
Let's see. Let's see if this works. So if
it doesn't, we can roll right into it.
Yeah. So
shut my camera down.
No, go ahead. Keep it on. All right.
Yeah, I can't turn it on now.
All right. Well, you got Rick's picture up there, so
that's a better picture.
I think everyone can see me now. So
so Dan, this is exciting. We got a lot of cool stuff here, and start us off as to what we're looking forward to in our quarterly conversations. I can't wait to talk about Tina again.
You love Tina. Rick teed it up pretty well here. That the market moves pretty fast. Blink and you missed it. This is a pretty interesting table from 2020. Everything was up pretty much across the board. Pretty much, just starting at the top here. Equity markets are up 18.39% on the year. And we've looked at this in a lot of our reviews, and you can see this reflected in all the portfolio reports. It really just doesn't tell the story. Obviously double-digit return year, always a good year. But from the beginning of the year through the downturn, through the bottom, which was March 23rd of 2020. Every equity index from large caps to small caps was down high double digits. S&P 500 down about 30%. International took the same kind of a hit, and fixed income also took a hit, particularly particularly corporates and high yield, took the same sort of a hit. The only thing that really held up during the downturn were U.S. Treasuries and the aggregate bond index. So not surprising, obviously, Treasuries are typically a safe haven, in times of market turmoil. We are going to talk a little bit about how that may be changing. But you see the inverse being true from the bottom, which was 323 up through the end of the year, and really the market turned around in a big way. Small caps were up almost 100%, so almost doubled in value. And even just the S&P 500 was up 70% from that bottom. So this was a pretty quick turnaround, and we talked a little bit about the disconnect between the market and the economy in in our last two quarterly conversations, I think. Just because it has been a very big disconnect. But the one thing we also see here is, treasuries coming out of the recovery have really been pretty anemic and plodding along. So that's something to keep an eye on.
That's when the treasuries went down. They never came back up. We'll talk a little bit more about that. But I see a couple of things here, Dan. The Russell 1000. Let's talk a little bit about that because, when you look at the S&P 500, the S&P 500 was up 18%. The Russell 1000 growth was up 38%. So, talk a little bit about what drove that market and what held the S&P from going down so far, where value is supposed to be a safe haven for everybody. But yet value went down 37% and the growth stocks went down 25. Can you touch a little bit about that?
Yeah, definitely. Couple things to be aware of in this market cycle where it is. So momentum is a big part of how stocks have been trading. And we're gonna get into this a little bit, but even with stocks being fairly expensive by most traditional measures, the trading is still there. Investors are still buying, Apple, Amazon, Google, Facebook, all the FANG stocks, even though they tend to be pretty expensive. So just from a trade volume perspective, value just doesn't seem as attractive to most investors. But the other thing that happens is market concentration. So growth stocks are enjoying a little bit more of the benefits from the cheap money policies of the Fed. So those growth stocks have been in favor over value really over the past decade, and we'll get a little more into what it's looked like over the past decade in terms of stock risk. But anytime you have cheap money, typically that's going to favor growth stocks and the momentum trading of growth stocks. So that's a really interesting thing that we see value value shares, typically your safe haven, are down further, and on the year we're really just looking at about a 3% return. But actually coming into the end of 2020 and the beginning of 2021, that seems to be changing a little bit, where value seems to be starting to eclipse growth as potentially the favored style moving forward. So
Yeah, and the other thing too to touch on, and I think we talked about this in our last quarterly conversations, where a lot of the areas of growth, when people transition from their office back out into the work from home world, and they couldn't go out shopping, they were afraid to go out shopping. Amazon kicked up aggressively. Zoom took over, as we're on Zoom now doing these meetings, where we would love to actually do them in person and record them out. But a lot of those companies that were in that growth cycle more or less took off because everybody got pushed out into a work and home environment, and to an environment where they had to order from home. So I think that really helped that growth category quite a bit.
Yep.
And the other piece of that puzzle is you see where corporate bonds have gone down pretty aggressively. That's where the S&P, or not the S&P, the Federal Reserve actually, the corporate bond market actually locked up during the beginning of the phase of the coronavirus, when everybody got pushed to work from home, and you couldn't trade. Then the Fed stepped in and opened up that market, started throwing, and I think they're still throwing about $120 billion at this market now, and helped to push the corporate bonds back up, and that's kind of what allowed the corporates and the high yields to grow at a much bigger pace, much faster pace than the treasuries. Treasuries kind of went down and stayed there.
Yep.
So I don't want to spend too much time on this slide, but I thought it was really interesting when we started putting those numbers up originally.
Yeah, and anytime we see return numbers like this within a given year, it's pretty natural that the next thing that we're going to see is incredibly expensive stock prices. So I'm sure that anyone who's paying attention to what's happening in the market, or even just the news in general, is seeing headlines that look kind of similar to this. So stock market is expensive. Is the stock market in a bubble? Where do you find value in a market like this? Things like that. So what we're looking at here, there's a chart kind of in the middle of the screen here. It's just the PE ratio over time of the S&P 500, and you can see the gray areas are recessions. But what you can see is, we're at a high. PE ratio of the market right now is hovering right around 35. Last time it was this high, other than the financial crisis, we're looking at the tech bubble. So there's a lot of talk about, are we in a bubble? Is the Fed, being, and some of it probably coming from us sometimes, is the Fed being irresponsible with their, cheap money policies, inflated asset prices? What does it mean for stocks in the long run? You think about, just common sense tells you if it goes up, eventually it's got to come down, or eventually the Fed is going to have to start tapering their liquidity. But just like every financial metric, this is just kind of telling one side of the story. So yes, PE ratios are high. For those of you who don't know what a PE ratio, essentially it's the price earnings ratio. So it's essentially a way to look at the adjusted price of a stock based on on the company's earnings. And typically, classically speaking, it's a measure of how expensive stocks are. And especially when growth over the past 10 years has outperformed value, typically towards the end of those cycles is when you start to see headlines about bubbles and the stocks are expensive, and when our PE ratio is going to start coming back down to earth. So this is kind of to be expected when you have a run up like we had in 2020.
And normal PE ratios back in the 90s, I remember, were 16.
Yeah.
And if the PE ratio was 17, 18, it was high.
Yeah.
And now I think the normal PE ratio is around 22 to 24, if I remember correctly. And now, they're talking that it's still too high. So I think that as we continue to move forward in this market, that normalized PE ratio will continue to go up. So the question is what is normal in a normal PE ratio environment?
Yeah, so normal. This is a good.
Here's Tina.
Yeah, good segue into kind of this concept of Tina. So I'm gonna try to make this TINA, not to bury the lead, TINA is an acronym that stands for there is no alternative. But I want to frame this in two different ways. First way is this. If we look at, and I hope this will show up, if we look at the 10-year treasury and we look at the S&P 500 earnings yield, not to be confused with the dividend yield. The earnings yield is earnings per share divided by share price. So it is a price adjusted measure of earnings rather than a straight up PE ratio. The idea with comparing these two is it's kind of finance 101. 10-year treasury is your risk-free rate. S&P 500's earning yield is your market yield. So you take the difference between the two, that's your risk premium. Essentially, it's a fancy way of saying that's the amount of excess return you get for taking the risk of investing in stocks. So we sort of just broke this down over the past 2 decades, last 20 years, looked at it in 5-year increments, and these are the average yields that you would get on a 10-year treasury and in the S&P 500. So back in the early 2000s, in the midst of the tech bubble was ripe to pop. And the reason I say that is because if you can get 4.7% on your money in a 10-year treasury and the S&P 500 earnings yield is 3.9%, well, the minute that you start to see some cracks in the facade and you start to be a little bit skeptical about the future of these high PE tech stocks, well, you just take your money out and put it in a 10-year treasury, because you're really not being compensated for the amount of risk you're taking. So there's a ton of sell side pressure on what were, I should say, already highly inflated stock prices. What we see today, well, let me back up for a second. Over the past 2 decades, one thing that has happened is the 10-year treasury, if you kind of look from the top down here, it's just been on a steady march down. 4.7% average yield over the early 2000s. Over the past 5 years, the average yield has been around 2%, and today it's barely over 1%. So we're talking about an astronomical decline in the risk-free rate, quote unquote. So today, the interesting thing about high PE ratios, is relative to the amount of compensation, if you will, that you're getting for taking the additional risk. Stocks actually don't seem that expensive. In other words, with interest rates being so low, the high PE ratio, relatively speaking, is not as concerning and not as indicative of a bubble, a bubble-like situation. What I want to point out is that throughout all of these, the one thing that kind of remains fairly consistent, I mean, it fluctuates, but there's no real trend that you can see here, is the S&P 500 dividend yield. You're basically earning, on average, this is, every stock is a little different, but on average, the S&P 500, a large cap stock, you'll get somewhere between 1.5% and 2% of a dividend yield. Now, for the most part, over the past 2 decades, an S&P 500 dividend stock, you're going to need to get some price growth in order to justify investing in that stock. And typically you'd look at the earnings yield and say, well, okay, I'm being compensated for this. There's a risk premium for putting my money in the stock market. Today, and it's really since since the easy cheap money policies of the Fed, probably from, from 2010 on. So just look at the sort of, last decade. The S&P 500 dividend yield has started competing with the 10-year Treasury, and in fact, today is 50% higher on average than the 10-year Treasury. So, and this is just on average. So, if you look in the S&P 500 and pick a dividend stock with high free cash flow who's paying a 2 to 3% dividend, with low volatility and strong income statement, strong balance sheet, it becomes really hard to lock your money up for 10 years at 1% when a steady large cap stock will pay you 2 to 3 times that just in its dividend. And this is where we get to the there is no alternative scenario, because a treasury almost just becomes, you're just guaranteeing that you're just going to tread water, and high inflation would pretty much knock out any of the gain that you would get from that.
Yeah, and we were talking the other day, Dan, about those dividends. We can actually just bundle up, pull all the dividends out of the S&P 500, put them against the wall, and just throw darts. And every one the dart hits, we can pull into the portfolio and do better than the Treasury, do better than a 10-year Treasury.
Right.
But and like you said, I think where we, if we're selective over the type of equities or over the type of dividend stocks that we go into, we focus on long-term paying dividends. We focus on dividends that actually have a constant increase over the last 10 to 20 years, where every single, and it might not happen every single year, but they consistently increase dividends. They never go down. So we buy into an equity that pays a decent dividend, that has strong free cash flows, that has lower debt, that has a good ratio and a strong dividend that has been strong for 20, 25 years and consistently have gone up. We can take a little volatility in that portfolio or in that stock and count on that dividend constantly going up. I think with the 10-year Treasury and buying in the 10-year Treasury or a lot of bonds at this point in time, that risk becomes, we can buy that Treasury at 1.05%, but what happens when interest rates start to go up a little bit? And that bond price actually drops down pretty drastically, especially on the 10-year, maybe going out even to 15 and 20 years, trying to reach for a little bit more yield. Reaching for a little bit more yield may be beneficial in that dividend paying stock. Even if you go back to the Blink scenario where we lost 37%, but pretty much broke even before the end of the year, those dividends continue to pay over and over and over and over again if you bought the right stock.
Right. Yeah, and it doesn't pay to go out 10 years, and that's where it becomes a situation where it's very hard to see an alternative from a security perspective. The dividends appear to be more secure than locking your money up long term at 1% or less. Which just so happens to be 1.05%. It was below 1 just 2 weeks ago. So I wanted to quickly give some perspective on what this means, and just a little bit of backdrop for a slide we have in a couple slides. So what we're looking at here is this is really long term. This is going back to, I think, 67. So we're looking at 50 plus years of market history. All this is just looking at the earnings yield, S&P 500 earnings yield, minus the 10-year Treasury. So this is meant to illustrate what is typically considered the risk premium for investing in stocks. And the interesting thing is really, I just want to call everyone's attention to this down here. So, I mean, really, since there's been excess liquidity in the market, it's the risk premium for investing in stocks has just been there the whole time. Even when even when the treasury yields were a little bit more attractive, um, you know, technically the earnings yield on stocks was compensating you for that risk. It's only recently that the dividend yield has surpassed the 10-year treasury. So that's a little bit of a newer phenomenon. But in general, the idea here is that interest rates have they've just been on a steady march down really since the early 80s. I mean, it doesn't require a high level of technical training to just see just this general march down in interest rates, um, to a point where it's becoming uh, it's becoming almost more risky to lock your money up long term in a safe haven asset like a treasury, um, because uh, our concern would be again that eventually rates are going to have to come back up. The interesting thing, there's a couple of interesting things about this, is that the Federal Reserve has committed to keeping rates low for the next 2 years, if not 3 years. So the Fed comes out with every quarter there's or every 60 days, I think it is. There's an FOMC meeting, Federal Open Market Committee. So you have Jerome Powell, who you see here. You have the chairman of all the Federal Reserve banks. There's 17 economists overall, which include the Federal Reserve Bank chairman of each of the central banks of all the districts across the country, and they come out with this report, and they call it the if you want to look it up on Google, it's called the Fed dot plot, and really all it is they essentially will give you an idea of where they see interest rates going. And they do it, current year, 1 year, 2 year, 3 year, and then long run. So right now, for 2021 and 2022, 2021, 17 out of 17 have rates staying at zero or near zero. Let's put it that way. 2022, so the entire year of 22, only 1 out of 17 had rates going up at all, and they said maybe they'll go up by 1/4 to 0.5%. All the way through the end. So this is 2 more years of low rates. 2023, we had 5 out of 17 saying rates might go up by about 1%. So we're talking maybe in the next 2 to 3 years, rates can start out going up.
So there really is no alternative.
It's hard to see an alternative. Long run, the Fed wants rates to be in the, maybe more the 2 to 3% range. So more of what you were seeing in those averages, for the Treasury, sort of in more normal circumstances. But the interesting thing about it is that the Fed already has a pretty hard job. The Fed has to keep inflation at a target rate of 2%, and the Fed has to maintain low unemployment.
Low employment. Yep.
Little somewhat diametrically opposed in ways, because if you try to keep inflation or if you try to keep inflation within a certain target range, it can be tough if you're also trying to get more people working and therefore buying goods and services and therefore potentially increasing CPI. So they always say the Fed has a dual mandate, and they're somewhat opposed. But the interesting thing is that and I don't know what this means. I've always said the Fed is supposedly an independent entity, but it certainly seems like they don't act like it. And Jerome Powell was recently quoted as talking about PEs in the stock market, price earnings ratios, talking about how expensive stocks are, and he essentially said No, stocks aren't that expensive. You can go ahead and keep buying stocks, and the rate is going to be low for a long. Rates are going to be low for a long time. So it is interesting for two reasons. Number one, it kind of tells us what we already knew about there is no alternative, and about the fact that uh, looks like dividends are kind of the new yield. But it tells us the Fed is watching the stock market. And this is going to be really interesting to see how it pans out, because the Fed's job is not to be monitoring asset prices. By saying the Fed has to target inflation, what we're saying is the Fed should be monitoring consumer prices. And this to us is an admission that the Fed is realizing more and more what their impact is on the market.
Yeah, their goal is to keep that market constantly going up. And they even took out the factor that, they're not even looking at earnings increasing. Prior to this mess, they were actually looking at three factors. They wanted to keep unemployment low, which they had prior to COVID. They wanted to keep the inflation at a 2% growth rate, targeted rate, and they wanted to see increase in earnings, and they never got that increase in earnings. It's possible that they could get that increase in earnings as inflation kicks into gear, but then the Fed's responsibility at that point then is tapering. How are they going to taper responsibly, and actually, what is responsible tapering? We saw the impact of tapering in 2015 when they started backing off. We lost a little bit in the stock market, so we will get some volatility on that. Dan, I think we talked about that the other day too. So, but I'll let you go to the next slide because I don't want to run out of time before we get to finish all the slides.
Yeah, so I think, and tapering, what's going to bring the Fed to do that is they need to see positive economic signs, and technically, uh, you know, uh, we want to see that for support of the higher market, right? Because the Fed can keep prices propped up with their easy money policies, but eventually they're going to have to whittle those back. And without a strong economy to sort of drive growth moving forward, then these sort of artificially inflated prices would subside. In other words, the market, would take a dip. So the good news is that generally speaking, I mean, what we're looking at here is the home price index. So the home price index is sort of back on track. I believe it was late 2018, early 2019. Home prices finally got back to where they were before the financial crisis. So that took over a decade for home prices to get back to where they were. And then you can kind of see it here. And it's this is a longer chart, but they've ticked up pretty drastically over the past year with COVID. There's been a ton of activity in real estate markets, as well as the fact that interest rates are low. This, just like the stock market, the Fed creating cheap money policies tends to pump up home prices just like it would with stock prices. But the interesting thing with home prices, real estate is a huge driver of the economy, and uh, permits and housing starts are hitting a high, and that's a good thing, because this is essentially pent up spending for the economy that has not happened yet. So it's essentially committed capital for real estate markets that will be spent over the next 3 months. So as these metrics are being measured, that's what this is looking at over the next 3 months. So um, that's encouraging, because it means that it's not just the fact that money is easy to get that is driving up home prices. It's the fact that there actually is real demand, and there is real spending driving that. So
Yeah,
I
you
think
can
that's
see
something good
that.
to see.
Yeah, you can see that in the 80s. In the 80s through the 90s, which fueled it, and it was all fueled differently, I think. It was fueled in the 80s by the uppie generation coming in and moving into the environment, and buying into the housing market. And interest rates were on its way up at that point in time, and it fueled that market. And then we kind of roll into the 90s, and another generation jumps in and continues to fuel that market in the 90s, more in the technology world. And now what you're looking at is the millennials now starting to move out of the cities, and I think COVID helped to push this too, buying into a housing market where there's people our age and greater all the way up into the 70s and 80s that aren't ready to move out yet. So that's pushing up the housing prices, I believe, in the way this market looks now. So this could go on. We might have a little dip. You see the dip that we had in the 90s, drop down a little bit and then pick back up again. But it's different now because it's being fueled by a generation, where going from 2000 to 2005, I think it was being fueled by a lot of excess money and low interest rates and people buying into multiple houses at that point in time. And then kind of crashed through the process because it wasn't the housing market didn't cause that particular crash. It was the debt that people were taking on their houses and where they were spending that debt that caused that crash. So the housing market is now just picking back up with a new generation and kind of rolling forward.
Yeah, and I think that is an important theme.
The changing of the guard.
So Rick is talking about Rick's talking about different generations and how that fuels housing. And one thing that we think about is and continues again to be one of those major themes you see in headlines is how concentrated the S&P 500 is, how big the big companies are. That some of these large cap stocks are now mega cap or giant cap or whatever you want to call them, but essentially the FANG stocks. So the ones that we all know today: Apple, Amazon, Microsoft, Google, and Facebook. The S&P 5, if you will, essentially taking up almost, not quite, almost a quarter of the index. So you can see it's the percentages are down here. It's like 22% of the index. Interestingly enough, this is not a new phenomenon. And if you look over the past 20 years, or I'm sorry, 40 years, we've had similar outcomes before 1980, 2000, and now 2020. And this orange sort of wave chart on the bottom represents how concentrated the index is in the top 5 companies. Has nothing to do, seemingly, with the performance of the index, performance of stocks as a whole, the market as a whole, which is what you can see on top. And this is somewhat anecdotal, but we kind of look at this as a changing of the guard. So back in 1980, you look at those names, you see some remnants of the Industrial Revolution with Exxon, Standard Oil, Schlumberger, and you start to see the inception of the technological revolution. IBM, and at the time AT&T was more of a tech name than closer to a utility name nowadays. And then 2000, right before the tech bubble, you see the culmination of just that, the culmination of the technological revolution. Microsoft, GE, Cisco, Walmart made their way in there, Intel. So, think about Intel, Cisco, Microsoft. Microsoft in 2000 was, a PC on every desk, and Intel was making the chips. Microsoft's the only name that shows up here twice because Microsoft nowadays is Outlook and Microsoft Teams and cloud storage. So Microsoft adapted their business model, but you can see that moving into the next 20 years, from 2000 to 2020, we become big data, the information age. Google, Amazon, Apple, Facebook. So we see the market concentration level as a signaling of a changing of where the economy is focused on its growth. And the interesting thing about where we are today is purely based on the level of concentration. It seems like we're at an inflection point. And the question becomes, what is going to drive the market over the next 20 years? Because typically, when you get to a point where the market is this concentrated, it starts to subside over the next 10 to 15 years. As you can see it, from 80s to early 90s, 2000s to 2010, 2014. So this is something that we want to pay attention to from the perspective of market concentration.
So I just got a question up that
Okay.
many of the young folks that you hear, you actually hear them complaining about housing being too expensive. How will that affect growth? And I'll answer part of this question, Dan. I don't know if
Yeah.
you want to capture the rest of it, but
Mhm.
I think what's going to end up happening is housing prices are too expensive. But right now, when you look at what's moving off the market, or moving on the market right now, are housing between $300,000 and $500,000. As you start getting up beyond $500,000, that market starts slowing down. And I think what's going to happen is eventually the older people will start moving out of their houses and that inventory will open up. And I think a lot of that right now is just a lack of inventory because the older generation isn't ready to move on to the next phase yet. So they're hanging on to their houses longer. And not only are they hanging on to their houses longer, but they're living a lot longer. I have actually a couple of clients in their low 90s still living in their house and want to continue to live in their house until they don't want to ever go into a nursing facility. So they're really hanging on to their house for a long time. But once those inventories start to open up, I think the opportunity for the younger generation to step in and start buying houses, you'll see that drop off in housing a little bit, I believe, as the inventory starts opening up, and housing prices will get a little. They won't ramp up for a long term, but they'll continue to ramp up and they'll continue to taper off and then ramp up. But I think at least over the next 15 years, when you stretch out that line, you'll see an increase, but not without slight depressions in that housing market. Anything you want to add to that, Dan?
I agree with everything you just said. I think we really saw it in 2020, the disconnect between the supply and demand, because COVID ushered it in, but it's been there for the last 5 years. And I think that typically what's really happening is a lack of supply and a trickling in of demand, who in a marketplace which, it's I read somewhere about how the reason inflation doesn't exist in consumer prices is because of a name that you see on the screen right here, and that's Amazon. So inflation doesn't exist because every consumer, no, it doesn't matter what store you're in, the Amazon effect is that every consumer has a price checker in their pocket, and it's Amazon and Google. So and the hardware is provided by Apple. So you go on your iPhone and you say, what does this cost online? So it's really hard for inflation to exist because price arbitrage isn't there anymore. The consumer market is more efficient than it's ever been. And I think there's a similar phenomenon happening with real estate, because there's demand under the surface. It's just that most of the demand is checking prices on Zillow. Most of the demand isn't going out and getting housing permits. Most of the demand isn't going out, which is why it's encouraging to see that happening, and see permits hitting a high at this point in the business cycle, because most of the demand is just waiting for there to be enough supply. And
Yeah.
I think that that illustrates, what Rick is saying, is that there's just not enough supply out there.
Yeah, it was, we kind of had a slingshot effect coming into the COVID situation, because housing at the peak of when housing really gets aggressive in January, February, March, April, COVID kind of stopped everybody from going anywhere. And then the beginning part of that millennial cycle, the older millennials basically had a lot of their debt paid off for school, and they had really good jobs, and they had the funds to be able to go out and buy it, and they were just slingshotted back, and they flew into that market, which just ramped up aggressively and allowed housing prices to start, really big jump like that. So, but I do believe you'll see it taper off at one point in time. It's just a matter of how far is it going to go up before it tapers off.
That's a a really good segue, because
You're
that's
welcome.
how I was going to close this out, is how far is it going to go up before it goes down. Um, so this is another thing you're probably going to see in the headlines, another word you'll probably see, which is the secular bull market. And I just want to kind of draw a little bit of a contrast here. So we heard about bull markets, bear markets, recessions over the past 100 years, starting with the Great Depression in 1929. There have been 15 technical recessions. What that means is 15 times the stock market, the S&P 500, has contracted by 20% or more. That's a technical recession. Now the secular bull market, there have been, so that what that means is, inversely, there have been 15 technical bull markets, because every time you come out of a recession, you're coming back into expansion. But the secular bull market is a little different, and it has more to do with the business cycle, and it has more to do with what's driving economic growth. So it has to do with the current interest rate environment is typically associated with lower rates. So a secular bull market, rates are typically lower, as we kind of already discussed, they are today. And the contractionary periods of these business cycles, which you can see in the red boxes here, those would be the more recessionary periods. So not technical recessions, but you can see that these are, decades plus long points in time where, if you're invested at the beginning and you sell at the end, you pretty much made nothing. And we talked about the 70s, in our last quarterly conversation, a little bit about how, if you invest at the beginning and you sell at the end, you pretty much just broke even. And then there were lows, obviously in between that. But that's what this chart illustrates, is we're in pretty much the third distinct bull market of the past century. The first really being driven by the Industrial Revolution, the second being driven by the technological revolution, right? We talked about how Intel and Microsoft and Cisco were the big names, heading into the early 2000s. And then recently, what I can only think to refer to as the data revolution, or the information age, where by most accounts of the length of the business cycle, we are still in the early to mid innings of. And the question becomes, knowing that low interest rates typically drive these secular bull markets, knowing that economic growth, and in a lot of ways, the changing of the guard, the changing of the innovation behind that economic growth typically drives this. The question becomes, knowing that the Federal Reserve has put so much liquidity into the market in a way that has never been done before, can they start to scale that back in a way that can bring this in for a soft landing. In other words, to let it continue growing. And that's really what keeps us up at night is what's the Fed going to do and when.
Yeah, like tapering responsibly.
Right.
That's going to be an interesting task. Yeah, so and you see that upward trend that we're going into in the secular bull market. Don't be fooled by, we are pretty optimistic about the market in the future. We are pretty optimistic about where we're going long term, but it's not to be without ups and downs or downward falls in this market. Everybody wants to know when the next downward market's going to be. It's coming. The question is when and how much. And the more important thing is how high up are we going to go before it drops down? So you're going to continue to see that. It's not without the fact that we are still optimistic about it, but we are going to have those downsides. Our goal is to constantly take advantage of those downsides when they come. When you see them, don't blink because it could pass by us. So, it's opportunity when we keep portfolios in cash and we keep those balances in. We talked about, the low interest rates. Well, we're looking to protect the portfolio, but we're also looking for where to go when there's opportunity. So, you have any more to say about the secular chart or about the secular bull market, Dan?
I don't. I think I want to wrap here and just keep this long-term perspective. And if anybody has any questions, I will I'll pause here and we'll be happy to take your questions.